Internal Revenue Service Circular 230 Disclosure. Pursuant to Internal Revenue Service Circular 230, we hereby inform you that any tax advice set forth herein with respect to U.S. federal tax issues was not intended or written by E. Brian Singer, Sean Singer, EBS Group, EBS Responsible Wealth, or EBS Business and Investment Group Incorporated to be used and cannot be used by you or any taxpayer for the purpose of avoiding any penalties that may be imposed on you or any other person under the Internal Revenue Code.
Welcome. I'm Brian Singer. Thank you for watching this very important video on special use valuation rules for farmers and ranchers under Section 2032A. Our website, www.ebsresponsiblewealth.com, has my bio and probably every other piece of information that you'd like to know about me. That said, I would like to say that in the 35 years that I've been involved in tax-related matters, I may have saved my clients and others who have come to my lectures hundreds of millions of dollars in estate tax. And I'm hoping that maybe I'll be able to do something great for you. So if you like what you hear today, you can contact me through our website, www.ebsresponsiblewealth.com, to arrange for a free confidential consultation. The IRS doesn't care about you, your family, your farm or ranch, or fairness. Their sole purpose is to extract as much money out of you in the form of taxes, both during your lifetime and at death. Consequently, you may have to jump through a few hoops if you're going to keep the government from taking your property. That is just the way it is. By implementing sound and practical strategies, you may be able to preserve the accomplishments from a lifetime of work for your family. Section 2032A is one of many tools. So let's see what it's all about. Section 2032A is designed to provide an estate tax savings to certain farmers and ranchers. It can allow you to value your real property at an amount that is less than its highest and best use, such as a housing development, which is how it would normally be valued for purposes of the death tax. For 2010, the maximum amount that the value can be reduced is $1 million. In future years, the $1 million will be adjusted for inflation, rounded down to the nearest $10,000. Now, for some taxable estates of modest size with less valuable farm or ranch properties, a $1 million reduction in value might help solve your estate tax liquidity problem. But for larger estates with more valuable properties, it is just a spit in the bucket. In determining the amount of your death tax savings, the rules allow you to value your real property using either the farm valuation method or the closely held business valuation method, which is also referred to as the multiple factor method. If there is comparable land from which the average annual gross cash rental or the average annual net share rental may be determined, you may use the farm valuation method. If that information is not available, or if the executor elects, you then use the closely held business valuation method. The IRS rules on how to determine value under the farm valuation method are complicated and burdensome. There are court cases and rulings which analyze nebulous issues and fine points. It will not be easy for an appraiser to determine a comparable gross cash rental or net share rental acceptable to the IRS. In determining value under the business valuation method, the IRS looks at 5 factors without providing a whole lot of guidance as to how much weight should be placed on each of the 5 separate factors. This once again makes it difficult for an appraiser to determine a value acceptable to the IRS. Regardless if the farm valuation method or the multiple factor method is used, the highest and best use value must also be determined because the reduction in value resulting from the special use valuation method cannot exceed $1 million in 2010, and that amount will be indexed by inflation in the future. I'm going to give you a brief summary of what it takes to qualify for the valuation discount. 1. You must be a citizen or resident of the United States and the real estate must be located in the United States. 2. You or a family member, as family member is specifically defined, must have owned the real estate for periods aggregating at least 5 years out of the 8 years prior to your death. 3. For periods aggregating at least 5 years out of the 8 years prior to your death, the real estate must have been used in a qualified use, as that term qualified use is specifically defined, by you or a family member. 4. You or a family member must have had material participation, as the term material participation is specifically defined, in the operation of the farm or business for at least 5 of the 8 years immediately preceding the earliest of A, the date of your death, B, the date on which you became disabled provided disability continued until the date of your death, or C, the date on which you began receiving Social Security, retirement benefits, provided the benefits continued until the date of your death. 5. The real estate must pass from you to a qualified heir, as the term qualified heir is defined. 6. On the date of your death, the real estate must have been used in a qualified use by you or a family member. 7. 50% or more of the adjusted value of your gross estate must consist of the adjusted value of both real or personal property that on the date of your death was being used for a qualified use by you or a member of your family. 8. 25% or more of the adjusted value of your gross estate must consist exclusively of real property, as opposed to real and personal property that on the date of your death was being used for a qualified use by you or a member of your family. 9. The executor must irrevocably elect on the estate tax return to value the property under Section 2032A. 10. The executor must file an agreement signed by every heir that has an interest in the property to which the election applies. In the agreement, each interested heir consents to personal liability for any recapture tax, which I will be discussing, and to allow for the collection of the recapture tax from the qualified property. The 50% and the 25% requirements cannot be determined until all the fair market values of all the assets in the gross estate and liens are determined. Nonetheless, it is important to determine the likelihood on a preliminary basis whether the 50% and 25% requirements will be met. There will be a recapture of the estate tax benefits if the qualified heir sells or transfers the real property to non-family members or stops using the property for farming within 10 years of your death. During the 10-year recapture period, if the heir or a member of his family does not materially participate in the operation for periods aggregating 3 years or more during any 8-year period, the recapture tax will be triggered. The property must be used for farming throughout the 10-year recapture period, but there's a 2-year grace period immediately following the date of your death. The recapture period is extended by any grace period expiring before the heir begins to use the real property for the qualified use. A special lien attaches to the property for the amount of the estate taxes saved. The lien applies automatically and will be recorded. A like-kind exchange under Section 1031 of qualified real property solely for qualified replacement property to be used for the same qualified use as the original qualified real property will not result in a recapture. A recapture tax will result to the extent non-qualified property is received. If as a result of an involuntary conversion, the specially valued property is replaced by other farming property, there will be no recapture tax if the cost of the replacement property equals or exceeds the amount realized on the conversion. A partial recapture tax can apply if all the proceeds are not reinvested. A qualified conservation easement by gift or otherwise is not a disposition for purposes of the recapture tax, nor is it treated as a cessation of qualified use for special use valuation purposes. The full permissible valuation reduction of up to $1 million as indexed for inflation is allowed for each spouse's half of the community property interest. The rules for determining whether an interest in an entity that owns qualifying property is entitled to a valuation discount under Section 2032A are complicated and beyond the scope of today's presentation. It's nice to have Section 2032A in your back pocket, but you don't want to rely on it to solve your estate tax problems. The technical requirements of the law have resulted in many family farms not receiving the relief that was intended. IRS estate tax examiners have a history of using the slightest technicalities to prevent farmers and ranchers from making this special valuation election. All the confusion and complexity may have placed a premium on the skill and nerve of the lawyer who ultimately handles your estate. Unclear rules, tricks, traps, and obstacles have the effect of limiting the benefits to only the most sophisticated and cautious. The legal costs, appraisal fees, recorded tax liens, and personal liability of the heirs are all deterrents, considering that the valuation reduction is limited to $1 million, as adjusted for future inflation. And then there will be the defense costs upon audit of the estate tax return. In the end, you better plan on having the cash to pay estate taxes. Ideally, the cash should come from a source that is not itself subject to estate tax. That means planning ahead. For many farmers and ranchers, a properly structured life insurance policy is the only thing that will prevent a forced sale. A life insurance policy with a guaranteed premium and a guaranteed death benefit provides certainty by creating an exact amount of money when it is needed most. Life insurance proceeds, when the policy is properly structured, are received income tax and estate tax free. Life insurance in a sufficient amount can provide the funds to pay the estate tax on all estate assets, not just the farm or ranch. Life insurance can eliminate the required diversion of cash away from the farm operation to pay an obligation, the tax bill, which provided no benefit to the growth of the business. Life insurance can eliminate the need to prepare the farm today to fund a future tax bill. Life insurance can help equalize inheritances between operator children and non-operator children, and life insurance can be used to pay off business debts and leave the farm operation in a better position for continued success after your death. Only you can make it happen. Your family is counting on you. Thank you for watching this video. There are many tax-saving opportunities that I can make available to you. I am here to help you keep the IRS's greedy hands off of your money that should rightfully go to your children, grandchildren, and favorite charities. I bring to you the best of the best tax strategies, the best of the best attorneys, and the best of the best life insurance products. I hope you will choose to meet with me, and here is our contact information.